Good evening. This is Ken Long from Tortoise Capital Management with a review of the weekend reports for January 8th, 2011. Market is in bull quiet mode. We are slightly overbought on an annual weekly RSI basis at 71 out of 100. And on the 10-day index, we've pulled back to the high range of neutral at 75. The 200-day moving average percent stretch and the slope of the 50-day moving average are both very strong, very bullish. ADX 14 has moved north of 31 to get up to 31.7, or a very strong, powerful bull move. ATR percentage remains quiet but has moved up slightly to 0.68%. This week, the U.S.'s performance for all major indexes has returned back to the middle of the pack, while certain Asian and emerging market countries are starting to get stronger. Precious metals, commodities cooled off a bit. Energy remains strong. Financials are a new source of strength among the global and U.S. business sectors. So we're looking for more from financials. Monthly and quarterly rebalancing are still holding techs, U.S. mid-caps, and U.S. small-caps, with the next reevaluation due about 1 February and 1 April, respectively. The ETF2 system, theoretical model exposure is at 90%, but the model portfolio remains at 100%, fully invested, stops in place, and none of those were hit this week. In the market health check, again, you can see we're looking back 10, 20, and 30 days. And let's clean this up just a little bit. There we are. We're looking back 10, 20, and 30 days. The slope of the 30-day regression line is the central black line, still remains up and strong, although you can see that we're developing greater volatility during the opening days of January 2011 as compared to the very quiet bullish move of December. The red lines, horizontal red lines, are support and resistance lines from previous price action. The next significant support level is at approximately 125. You can see that price is better than the 20-day moving average in green, better than the 50-day moving average in red, and the 200-day moving average is not even on the screen. It's at about 114. So this is the very definition of a strong bullish move. The 10-day Williams percent R, this is the third time it has pulled back from overbought conditions in the last month, and each of the two previous times there was a corresponding channeling move upward. Remains to be seen if this one is sufficiently strong to continue its upward move. On an annual basis, we remain firmly overbought with Williams percent R just at about -2. The ADX has moved from its low below 15 all the way above 31 to be at 31.7. And with green above red, we still have a powerful bullish move, although it's starting to look a little longer in the teeth. The last significant pullback we had, when it rolled over, it went from 122 to 117. That's $5. That would bring us from about 128 down to vicinity 123, or close to testing the 50-day moving average. So we're going to be prepared for that. A $5 move is less than 5%, and that would be classified as noise. Looking at the ETF2 report. There we go. Spread this out a little bit. Looking at the ETF2 report, the top 10 indexes of the world market model, weakness in Europe and the Euro-Asian large caps, strength generally across the board in the U.S., led by technology, then small caps, then mid caps, then the broad S&P, which are all overbought on a weekly RSI basis, slightly overbought, but overbought nevertheless. with 9 of the 10 indexes positive for the 5-week rate of return. The theoretical model is at 90% exposed and 10% in cash. Looking at the expanded world market model, you can see weakness relatively in oil and gold. It's pulled back just a little bit, although gold remains exceptionally strong. Oil, there's still room for it to grow. Despite how much it's gained lately, it's still in pretty good shape. Energy, you can see in the U.S. sectors, is strong, and now we're starting to see strength in the financials. A green score on the strength and a red score on the quality is a reflection that this is early in the turnaround of financials, and that the volatility of going from horrible to excellent creates a lot of volatility, which gives it poor marks on quality, but because the most recent move has been up, it gets high marks on strength. In the global corresponding sectors, again, you can see that energy is doing relatively well and financials are coming along, but there's now some weakness starting to creep into materials. On the integrated world market model, you can again see the U.S. stuck in the middle here in the white sectors, slightly above average. We can see strength returning to the emerging markets and leaders of the Asian markets. These were all strong before the U.S. run-up in September. These were all the strength leaders from ETF2, Hong Kong, Malaysia, Singapore, South Korea. India, on the other hand, getting slammed pretty hard, and as a bottom feeder, I'm very interested in that. Pullbacks in oil, gold, and treasuries. Europe is still getting punished severely, as you can see by all the red. Latin America and the rest of the Western Hemisphere is lagging slightly behind the U.S. In the lineup of the business sectors, U.S. and global, again, you can see the strength in energy and finance leading the way. Most sectors of the world model are in pretty healthy condition, as you can see by the number of buy signals on the 100 by 200 crossovers. There's only a few in the area of U.S. real estate and the European large caps that still haven't managed to come up out of the hole yet. The first time in about 2 months that silver has not been the strongest ETF in our ETF2 database. Moves to second place, taken over by coal. It's a commodity, it's energy, it's still in pretty good shape. You can start to see some of the those Asian countries creeping in again. Malaysia, Singapore, Hong Kong, even Mexico has moved up into here. Now the U.S. small caps are still on the list, but they're starting to drift down a little bit, and you see quite a rich number of the energy sectors still in play. And that's a quick look at the weekly strategy report going forward. It's a strong, bullish, quiet market, but starting to show signs of getting a little long in the tooth. We're going to be aware of the possibility of rotating into Asian countries at the high end, and then stalking India on the low end, looking to reward strength and energy. And if there's a overreaction against this Arizona tragedy, it wouldn't surprise me to see gold and silver being bought on a dip as a hedge against uncertainty. So keep your powder dry and good hunting. This is Ken Long from Tortoise Capital, wishing you a safe and prosperous new year.